All right. Hello, everybody. Welcome back to our Retirement Basics video series. Today's topic, Retirement Basics number 4, tax savings using net unrealized appreciation. Folks, you might recall from the first couple of videos we talked about the importance of understanding the significance of taxes when it comes to retirement. And there's no way to know exactly what that liability is going to look like until you have built out a customized personal retirement analysis. And that's a free tool that we offer to all of our prospects and clients that want to get in and dive deeper into what is their tax liability going to look like in retirement so that we can help limit the reach of the IRS into your retirement savings. Where does this tax problem come from? Well, specifically, when you think about retirement. The majority of us are trained to think about how at retirement, the pension, if it's a lump sum option, as well as the savings plan, can be rolled into an IRA. Now, most traditional financial planners are going to tell you that you can probably live the first few years of your retirement in an extremely low tax bracket. And they're right about that, but it's not necessarily what you should be doing. Why? Because as you think about the problems that come about in retirement, many of those problems are avoidable when you try to think about the potential for tax problems later on in retirement, specifically when you think about the tax problem that comes at age 72. When we deal with things like required minimum distributions, you are going to see a noticeable uptick in your retirement taxes paid. This is an example of somebody who's taking $150,000 of retirement income with a very modest 2.5% inflation kicker each year. Look at the increase in the green line starting in year 2031, which represents the first year that this person turns age 72 and is now responsible for required minimum distributions. Folks, the whole point is that IRAs, 401ks, other qualified retirement savings accounts are all subject to those RMDs at age 72. And if the retirement savings are left alone unchecked in the early years of retirement, that could be a surprising tax liability for you when you wake up at age 72. So what can we do about it? There's a couple of things that we offer as traditional strategies for helping generate some tax savings when it comes to retirement. We're going to talk about one of them here today, known as NUA, or net unrealized appreciation. I know we talked about the idea that a 401k savings plan can be rolled over in its entirety to an IRA rollover back in video number 2. That idea still holds true, but it might not be your best option. Why? Because if you've been buying ExxonMobil stock inside your savings plan for a number of years, you very likely have the opportunity to take advantage of a tax benefit known as NUA. Folks, NUA is simply defined, it's an IRS tax strategy that allows you to take low basis company stock out of a 401k savings plan, moving it directly into an individual or joint after-tax brokerage account. Now, that may sound confusing. Those are IRS terms. Why does it matter? Well, simply put, the opportunity to take stock from a savings plan directly into an after-tax brokerage account means, number one, we circumvent the IRA altogether. We are not putting money in the IRA that's going to continue to grow and be subject to more taxes at age 72. Number 2 benefit is there are some tax benefits to taking stock out of a savings plan at a lower cost basis, moving it into an after-tax brokerage account. Very specifically, here's how it works. Let's say you've got ExxonMobil stock in your savings plan at a lower cost basis than today's market value. For most of you, that's not very hard to realize. If you were buying stock back in the 70s, 80s, or 90s, it is very likely sitting at a gain in your 401k today. When we look at that benefit, the idea of NUA allows you to move stock out of your 401k into an after-tax brokerage account and only pay taxes on your original cost basis. There are some significant benefits to that. First of all, remember, the cost basis is a lower dollar amount than today's market value. The ordinary income that you'd be recognizing on NUA can be done in portions. It does not have to be the entire balance of your 401k stock holdings. Therefore, you can decide how much of a tax liability you want to take on in the year of retirement. The stock simply moves from the 401k savings plan into an after-tax brokerage account where it is now subject to long-term capital gains if you decide to sell the stock. All right, it sounds good in theory, but how does it actually work? Well, let's walk through an example. This is an actual client we've worked with that retired from the company after a 39-year career. He had been buying the stock his entire career, had some extremely low cost basis down in the $7, $8, $9 per share cost basis, but his total shares held in the plan were a little bit over 17,000 shares. His cost basis from those shares totaled $658,135. Now, how do I know that? Very simple. I looked at his Voya statement. Page 4 is the spreadsheet looking page that has a list of every share he's ever purchased and the cost that he acquired it at. All I did was add up the cost basis column to get his total cost basis of shares so that I would know those 17,096 shares had a total cost of $658,000. The total market value of those shares at $90 a share, $1.538 million. Does NUA matter for this, gentlemen? As I said, if the cost basis of your shares is less than today's market value, yes, NUA is an obvious benefit to him. So how many shares should he take as NUA? Simple question would be, okay, what about all 17,096 shares? My answer would be, please don't do that. Why? Because the rules on NUA state that when you use NUA, you will recognize the cost basis as ordinary income in the year that you exercise NUA. For most of you, that'll be the year of retirement. So if he recognizes all shares as NUA shares, he will report $658,000 of cost basis in the year of retirement, which means he just shot himself up to the 35, maybe even a 37% marginal bracket. Not a good idea. That's paying way too much in taxes. So the question becomes, how many shares should we exercise? Somewhere between 1 and 17,096 shares is the obvious answer. Let's show you some math. Looking at his situation, we said, what if we took all of his shares up to $25 a share? Again, run down that spreadsheet page on the back of the Voya statement. And what it basically showed us is that he had 6,359 shares that had a cost basis below $25 a share. Now, that seems kind of random. Why did we choose $25 a share? Very simple. We noticed that at $25 a share, those $6,359 had a total cost basis of $76,448. Again, seems pretty random, right? Why did I choose that? Well, there's a strategy here that I didn't mention at the beginning. The IRS has a special provision. It allows you to use any after-tax contributions to directly offset your cost basis for NUA shares. All right. Again, translating that into English, it says, if you've been saving in your after-tax contribution bucket, how do you know that? Again, go to page 3 of the Voya statement. There's going to be a line item, post-1986 after-tax contributions. That dollar amount is your total after-tax contributions. In his case, he had $79,967 of after-tax contributions. Why is that such a benefit? Well, again, the IRS says that you can use those after-tax contributions to effectively swap with your NUA shares, reducing your cost basis dollar for dollar. His $79,967 of after-tax contributions reduce his cost basis of NUA shares to zero. That's right. His 6,359 shares of ExxonMobil stock come out of his 401k savings plan. They go into an after-tax brokerage account. He now has a market value of $572,000 tax-free. He did not have to pay any taxes at all to do this transaction. In fact, he even had $3,519 of after-tax contributions left that we're going to move out and put into a Roth IRA for his benefit. Folks, that's a terrific strategy. And I'm going to tell you that never again will you have an opportunity to take that kind of money out of a 401k absolutely tax-free. Those shares transfer into an after-tax brokerage account. He had it in a joint account for he and his wife. And one more benefit, those shares in the after-tax account do not need to be sold. They will now continue to grow. And any dividends he receives off of those shares going forward are considered qualified dividends by the IRS. What does that mean? It simply means that the tax on those dividends will max out at no more than 15%, even if he's in a higher marginal bracket. there are some major advantages to doing so. Now, I'll be honest with you, the $25 a share exercise here looks perfectly good. There's no reason to question it, but we actually told him he needed to do a little bit more. We actually suggested that he go all the way up to $35 a share, taking 9,583 shares of stock out of his 401k savings plan, moving it over into the after-tax joint brokerage account, where he would now have $862,470 of market value in his company stock in this after-tax account. Now, first you look at that and you say, well, why on earth would he do that? He's going to have to pay taxes on that money now. That's true. These 9,583 shares of stock we're taking out of the savings plan have a total cost basis of $187,488. Now, again, that's obviously more than his after-tax contributions, but I'm still going to use those after-tax contributions to reduce the value of his cost basis. His cost basis goes down to $107,521. One thing we did with this individual, we ran an analysis to determine when he was going to retire and what his estimated liability would be that year. Fortunately for him, he was retiring at the beginning of a year. He didn't have to recognize a lot of salary that year. As a result of that, his total marginal bracket with that 107,521 still kept him in a 22% marginal bracket, which means his total taxes due were $15,371. That's a check he's going to have to write to the IRS when it comes to his reporting. Again, many of you are looking at that going, why would you do that? Why do you want to pay those taxes? The reason I want to pay those taxes in this year is because you will never again see an opportunity to get $862,000 of market value out of your 401k and only pay $15,000 of taxes. It's still a tremendous benefit. The question really becomes, how did we know that 9,583 shares were the optimal amount for him to take out? And that's simply based on the calculation. NUA calculations work like a bell curve. There's a point where you continue to get optimal benefits from doing more shares until the point that you don't. That point really involves your personal situation, determining how much income you're going to recognize in the year that you exercise NUA, how much additional income you'll recognize from NUA. And we plot all of that out, building out the spreadsheet to show exactly where you need to stop at NUA. Folks, again, NUA is a tremendous tax savings tool. I really hope you won't let any other financial advisor or CPA tell you that, oh, it's confusing. Don't worry about it. Let's just sell those shares and put them into the IRA. That would be a big mistake. Why? Because any company stock that you move from a 401k to an IRA now has dividends generated that are going to be taxed as ordinary income. Remember back to video number 2, any distribution you take from an IRA, it doesn't matter if it was your company stock or other investments, is always treated as ordinary income. The primary benefit of NUA is it skips the IRA altogether, giving you preferred tax treatment, only charging you ordinary income taxes on the original cost basis. Hopefully, in this case, that was lower than today's market value. One more benefit. When we look at those shares in the after-tax brokerage account, I already mentioned that the future dividends off of that stock would now be qualified dividends, enjoying lower tax rates. But even beyond that, if you decide to ever sell the stock inside the after-tax brokerage account, the sale of that stock would now be a long-term capital gain. Again, favorable tax treatment. For most of you, long-term capital gain tax rates will max out at 15%, unless you're in the absolute highest marginal bracket, in which case those long-term capital gains max out at 20%, still a tax benefit. There's a tremendous opportunity to using NUA when it's done properly. Folks, if you've not looked at this before, let me gather together our tax professionals, our CPAs, and our CFPs, our certified financial planners, to build out a scenario for you that you can see exactly how much NUA shares you should be taking in the year of retirement or in a year thereafter. As we close, let me wrap up with just a couple of very common questions that I hear when we talk about NUA. Number one, do I have to sell my company stock in order to do NUA? The answer to that is no. The whole purpose of NUA is moving the company stock from one plan to the other. It literally moves from a 401k at Voya into an after-tax brokerage account, and you're recognizing taxes on the cost basis, but you do not need to sell the stock. You could continue to own the stock indefinitely, passing it on to future generations, or you could choose to sell it somewhere in the future and enjoy those long-term capital gains rates. Well, what tax would I owe if I use NUA? Folks, the net cost basis of your NUA shares is what's important. And that net cost basis is considered ordinary income in the year of exercise. Depending upon when you use NUA, that would be reportable as ordinary income, which, remember, ordinary income is the same thing as salary or wages reported on your tax return, and it applies to the marginal bracket system. Well, if NUA is a tax benefit, why would I not NUA all of my company stock in this case? Well, remember what I said back in the example. By NUAing all of your company stock, you're going to recognize the entire cost basis as ordinary income in the year of exercise. That's probably going to be too much income to recognize, and it could potentially bump you up into a higher marginal bracket in the year that you exercise. Bad idea. Don't do that. Let us help you calculate the optimal number of shares to use for NUA. Last question I get, do I have to use NUA when I retire? Can't I save it until a later time? Well, the IRS rules are very specific, and they dictate that NUA must be exercised within the calendar year of your first 401k distribution after retirement. So in other words, if you retire near the end of a year and you decide I'm not going to touch the savings plan, I'm going to leave it at Voya and not tap into it for anything, you do not need to use NUA that year. In fact, for many of you, if you've recognized a lot of income that year, either from salary or other benefits, you may not want to take the 401k out that year and exercise NUA. You may want to wait until January of the following year. The trick is this: if for any reason you touch the 401k to get income out of it, if you need a distribution of any kind, it starts a clock. And that clock says that by the end of that calendar year that you take the distribution in, you must exercise NUA or you will miss out. Folks, I think by now you can see there are some really specific nuances to the NUA decision, and I don't want people making mistakes. This is the number one area where we see mistakes getting made. I strongly encourage you, let us show you the personalized retirement analysis that's going to answer those basic questions. Can I even afford to retire based on what I've got in retirement savings? And based on what I've got, how much income can I get? And what about those Roth conversions in NUA? How does all of that fit in to your personal retirement analysis? Folks, that's what we will build for you. There's no cost or obligation to this, no contracts to sign. You simply submit some basic information to us. We'll build out the plan within 24 to 48 hours, scheduling a meeting with you via Zoom or in our office in the Woodlands, Texas. Be more than happy to share with you what those obligations look like, what your best tax strategies are going to look like, and put some numbers on those hard questions that you need to ask. Folks, the way to start is by going to our website at engravewealth.com. You can click on the button that says Start Your Free Retirement Analysis. We will collect some basic information from you and then schedule a time to visit with you, making sure that you know the answers to all of those tough questions when it comes to retirement. Folks, we really can limit the reach of the IRS into your retirement savings if you'll let us show you how. Very simple process. We would love to help explain it to you. Please click the link and let us help you with that retirement decision. Have a great week, and thanks for joining us.